Hi, I'm Urian Timmer, Director of Global Macro at Fidelity, coming to you live from Toronto, headquarters of Fidelity Canada. And here are the 5 things you should know about the markets for 2024. Stock market's always important, of course, and especially this year, it always comes down to 3 things: earnings, interest rates, and sentiment. For earnings, it looks like we had an inflection last year. As of the third quarter, earnings stopped going down and started recovering. And right now, it looks like we are on track for that recovery to continue. So that's the good news. Interest rates have also come off their highs. They reached 5%. This is for the US 10-year Treasury yield. The Fed is expected to cut rates several times, so that's good news as well. The only caveat that I can come up with right now is that a lot of this is already reflected in the price. Remember that the stock market always discounts the future, not always correctly, but it does always discount. And sentiment, I think, already incorporates both a soft landing and a decline in interest rates. So we're coming into the year, having rallied quite a bit already in the fourth quarter of last year. So the question about broadening, right? Will the market broaden? We've had the leadership of what we call the Magnificent Seven. I used to call it the Nifty 50, but the really big cap growth stocks have really dominated the scene, not only in 2023, but really for the last 10 years. And so one really big question and opportunity for investors is that the market might broaden as it finally starts to break out of this 2-year-long holding pattern that we've been in. And if that broadening does happen, so if we see a rotation from those Magnificent Seven to all the other stocks in the market, so not only mid caps and small caps, or even the equal weighted market as opposed to the cap weighted market, and of course, going beyond North America also into developed international markets as well as emerging markets, that presents a very large opportunity set, because that's a lot of stocks who have not really participated over the last year's rally. So expectations are that the Fed will cut rates, as well as other central banks around the world. Expectations are pretty ambitious that the Fed will cut rates by 200 basis points or 2 percentage points. I don't really see that happening. I do see that the Fed will likely cut rates a couple of times. The Fed itself has signaled that already at its December FOMC meeting. And it makes sense that the Fed would give back some of the rate hikes, of which there were plenty over the last year and a half or so, because inflation has come down. The CPI has gone from 9% to 3%. The core PCE rate, which is the Fed's favored inflation gauge, has gone from 5.6 to now 2.9. So that is a good improvement. And when we think about monetary policy, we have to think about what that rate is above the inflation rate. So it's real rates as opposed to nominal rates. And by definition, if inflation comes down and the policy rate does not change, the policy actually tightens because the spread over inflation goes up. And so the Fed needs to kind of keep up with that. So as inflation comes down, it should lower rates in order to kind of maintain some steady state policy. So 3 rate cuts, which is what the Fed has signaled for this year, I think is quite plausible. But 6 or 7 rate cuts, I don't see happening, at least not in a soft landing scenario, which appears to be where we're heading. So one caveat to a soft landing, to a couple of rate cuts, and a pretty sort of benign scenario for the markets in 2024 is that pesky yield curve, which inverted over a year ago, and which had many investors worried a year ago when we started 2023. And of course, a yield curve inversion means that short rates are higher than long rates, which typically happens when a central bank raises rates quite aggressively, as the Fed and other central banks have done over the past couple of years. And historically, that has been a fairly infallible signal for a recession, actually. And so this is why so many investors were kind of worried a year ago. But everyone seems to have pushed aside the yield curve for now. The Fed is now cutting rates or is about to cut rates. It looks like it has stuck the landing. But can we discard the yield curve inversion signal entirely? The answer is no. We can't get complacent. We may get a recession at some point, maybe even in 2024. But remember, if you're an investor, timing the market on the basis of these types of events is really, really tricky, right? Because even if you knew when the recession would start, how long it would last, how deep it would get, you still need to figure out how much of that is actually discounted already by the market. So those are 4 variables that nobody knows. And that's why the playbook of sort of timing recessions and inverted yield curves historically has been very, very tricky to execute. So we have an election coming up here in the US, yay. And a lot of people, of course, are worried about what that means for the markets. And one thing that I've learned after studying election outcomes and their impact or non-impact on the markets over the past couple of hundred years, actually, is that the economic cycle usually is bigger than the politicians would like to believe. In other words, elections have less influence over the markets and the economy than is commonly believed. That doesn't mean that there is no impact, of course. Obviously, different sectors can be affected by regulation or not regulation or any kind of policy incentives. But generally speaking, the economy, which is about $28 trillion in the US, and the stock market, which is about $40 trillion, is bigger than any politician or any election outcome. Well, I think the energy market continues to look very attractive. I mean, oil, of course, has come way down over the past year or so. But I do think we're going to find ourselves in an ongoing energy shortage. And of course, any country or region that is strong in natural resources, I think, is likely to benefit.